You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Welcome to Retirement Friday. Today, we are going to talk about how much cash is too much in retirement. And you get a picture, I'm sure. At first, you're thinking, well, I'm going to retire. So now it's time to have a lot of cash, a lot of bonds, a lot of like fixed stuff and not suffer from the volatility of the market. Which, I mean, in an ideal world, if we could all park our millions of dollars into a high interest rate savings account at like 5%, that would be amazing. Unfortunately, that's not exactly how it works, right? We may not have millions of dollars. We certainly do not have high interest rate saving rates that will stay above 5% for several years. So we have to think a little bit more about this. Not too long ago at Retirement Loop, the community I started to help Canadians build their retirement plan and making sure that this ship stays steady throughout the retirement journey. I've received Adam Bourne from Parallel Wealth, a well-known CFP, and he's actually has an amazing YouTube channel, so you can find it on their Parallel Wealth. Over 100,000 followers on YouTube, kind of crazy, right? And we discussed like major retirement mistakes, and some of them like we're talking. We were like talking about like being a little bit too conservative and not having an income plan, and that gave me the idea of like going a little bit deeper into how much cash you need at retirement. When I was a financial planner, I actually had a client that was about to retire and at the same time inherited from a few $100,000, unfortunately. But I mean, that's life, unfortunately. So after he got that inheritance, he thought, I'm going to live on that cash for a few years. And once I'm going to run out of cash, I'm going to use my portfolio. So not really bad plan when you're thinking about it. I mean, you have like a stable source of where you can get the money from to complete your retirement budget, and eventually you're gonna like touch your portfolio. One problem that you have there is that client actually before I met him, he started to withdraw money from the cash reserve and eventually no more cash from the inheritance. And then he was like, oh my God, now I need to get money from the portfolio. We were in a bull market for that time, so everything seems to be working well. And then boom, the market goes down like a few months before he must start withdrawing money from his portfolio. And he had like no more cash left. And of course, that was like lack of having an income plan. And this is one of the first thing I work with that client is say, okay, so you should have an income plan and you should manage your portfolio in a different way. So instead of going like all in into cash and all in into fixed income, I mean, some people could do it. But when you think about that, can your plan works on like 2-3% return after taxes and everything, considering inflation and so on? Probably not. I mean, if so, yes, then you can wipe out all the expected returns and the volatility from the stock market. But if not, probably you'll need a portion of your portfolio into the market. What you don't want is to be forced to sell a portion of your portfolio that is invested in equities, regardless if it's in like mutual funds, ETFs, or stocks, when the market is down. Or like right now, the market is quite volatile. It's not optimal to sell stocks that are a bit down at this point. So what you could do instead is having a cash reserve. And that cash reserve, or also known as like a cash wedge, should be about 3 years of your retirement budget. So in that cash wedge, it could be like cash, high interest rate savings account, those that are ESA, ETF, so high interest rate savings account, ETF, GICs, short bond ladders, like 3 years. As long as it's super stable, as long as it's accessible and it's really cash, then you can consider this as a cash wedge. Not investing this in like ultra safe blue chips or investment products that are generating yields. Those are still tied to the market, so you don't want to be tied to the market with those 3 years. You want something that is like fully safe. Now, 3 years of retirement, if you need like $50,000 per year, that would be like $150,000 in cash. That could be a lot, right? That could be way too much. So the way you can calculate that 3 years is you can look at your portfolio first and imagine that you generate $30,000 in dividend and interest income. Well, then the missing part is really $20,000 a year to make it like 50. And I know maybe you're not gonna like retire on 30 or 50 or $100,000 a year. That's not the point. The point is like to make easy numbers to remember. So 50, you get 30 from dividend. There's $20,000 left. So your cash reserve should be 3 years of that 20,000. That would make 60,000. So same reflex. If you need $30,000 a year to retire from your portfolio, you generate $10,000 in dividend. There's another $20,000 left. So then you must put $60,000 into the cash reserve. So then on a good year, you sell shares. On a good year, it means that like your portfolio goes up. Well, then you can sell shares, replenish your cash reserve, or you live on that budget, and that's fine. When the when the market is going down, you get into that cash reserve. What happens if you have more than this? What happens if you have like $100, $200, $300, $500,000 into cash? Well, the problem is, yes, you get outside of the volatility. You don't have to worry too much about it. That's great. But what about the opportunity cost? And the opportunity cost in a sense that if you invest in cash, you're not going to grow your assets that much. Actually, in general, cash and GICs will barely and probably not even protect your cash against inflation. So you're not even protecting your capital. It's going to decrease even if the number on your bank statement stays the same or give you the impression that it goes up. After taxes and inflation, chances are that number will go down. So unless you have saved a lot or you don't need too much to retire on, just run the numbers, making sure that it works, because if it's not working, probably you need to invest in stocks. And again, the sequence of withdrawal being what it is, you don't want to withdraw a big part of that money when the market goes down. I am a big fan of having a cash wedge, and then having the rest in 100% equity portfolio. Why? Because let's say you go for like an easy solution, all-in-one ETF, like 60% stocks, 40% bonds, right? That would be like balanced ETF, balanced mutual funds. Pick the one that you want. 60-40, good balance, less volatility. That's great. You need money. Well, you're going to sell units, right? Units of that mutual funds, or you're going to like sell some of those ETFs. When you sell an ETF unit, the problem is for each dollar you get, you sold 60 cents of stocks and 40 cents of bonds. You cannot just sell bonds in this scenario. So it's still selling a portion of equity when the equity is down. So that's not exactly working. It's not the end of the world, but it could be optimized. So either you could have like cash and then bonds and then stocks separately throughout, like individual bonds, individual stocks, could be ETF, could be whatever you want. But if you go for like a package deal, I would probably go for like just cash reserve on the side and then the rest all in equity. Of course, you have to consider your volatility tolerance, because that is like super important. If you're not comfortable with that, well, then having bonds, individual bonds, preferred shares, or an ETF that tracks that could work very well. As long as you put everything inside a retirement calculation projection sheet that could tell you if that works, or what would be your retirement budget if you decrease your exposure to stocks. That is super, super important. And without running the calculation, you cannot really know. Like, it's impossible to figure that out by yourself. You need to run the numbers. Fortunately for you, we are about to reopen the doors to Retirement Loop. That's going to happen towards the end of the month of May, we're going to have a webinar showing you how we can help you build your retirement plan, how you can make different scenarios and answer all those what if questions. What if I retire earlier? What if I take CPP and OAS at the age of 65? What if I do an RRSP RIF meltdown strategy? Answering all those questions into that webinar. If you want to know more about it and be the first one to know about the webinar, you can register to the waitlist at moosemarkets.com/retirement. So moosemarkets.com/retirement. So, all right, Moose, that's enough for today. Enjoy your weekend. On Monday, we're going to finish the investment roadmap that we started this week. So make sure that you reserve some time on Monday. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.